Today we've seen markets split direction with the S&P 500 climbing 0.3%, closing at its 23rd record high of the year. The Nasdaq inched up only 0.03%, but that was enough for it to reach a new record of its own, while the Dow lagged, falling nearly 0.5%, and you could thank Apple's disappointing keynote, which has led the continued slide for Apple stock that has pulled the Dow down. And then gold, gold surged, locking in yet another all-time high for gold. So what fueled stocks? What pushed gold higher? Why are treasuries rallying? The answer came from one report we got this morning, which was the Producer Price Index, or what people commonly call it is PPI. And we got the numbers for August released today. And what PPI measures is wholesale inflation, and it unexpectedly cooled in the month of August. So PPI fell 0.1% on the month, leaving year-over-year rate at 2.6%. Now, economists were expecting the number to come in on a month-to-month basis at 0.3% to 0.4%. On an annual print, they were expecting to see this 3.3% figure. So this came in much softer than expected. But the slowdown, you could blame it. It was driven mainly by a 0.4% decline in energy prices and a sharp 1.7% pullback in trade services margins, which had spiked back in the month of July. Now, that swing alone was enough to pull the headline number negative, but we don't always just pay attention to the headline number. People like paying attention to the core price, which strips out some of the more volatile segments. So inflation isn't gone is what that one revealed. So the core PPI, which strips out food, energy, trade services, like I said, those more volatile segments rose 0.3% month over month, leaving it 2.8% higher than a year earlier. Now, within that, transportation and portfolio management services, they ran pretty hot. Then those are categories that flow directly into the Fed's preferred inflation gauge, which is PCE. Now, the immediate reaction was pretty textbook that we seen from markets. We seen treasury yields drop on the report. So let me pull up CNBC real quick and make sure y'all can see that just fine. So what we've seen is the 10-year fell to 4.04%, which was its lowest since April, and the 2-year slid closer to 3.5%. I don't have that on the screen, just use your imagination. But falling yields have boosted gold, which thrives when real rates decline, and equity investors initially cheered the softer inflation print, and especially Oracle shareholders who drove the S&P much higher today. Oracle climbing up as high as, I want to say, like 35% on the day or something wild. So congrats if you're holding Oracle stock. But here's where it gets pretty nuanced. While PPI headlines gave some type of relief for the markets because, yeah, like tariffs aren't, they might be this one-off inflation bump. It didn't actually change the bond market's expectations for the Fed and what the Fed's expected to do. And neither did it for the futures markets that watch that. So futures markets still show this 100% figure for the probability of a rate cut from the Fed on their September 17th meeting, with about this 92% expectation of a quarter cut and roughly 8% of a 50 basis point cut, or 0.5%. So despite the headlines today, the data didn't necessarily move the needle much. It didn't alter the trajectory markets were already betting on. I'm thinking that's because people are waiting on some more important data that we're going to get tomorrow. So be sure to tune back tomorrow, everybody, because tomorrow we get the CPI report. Now, the PPI and the CPI report both play into the Fed's preferred measure of inflation, that PCE, personal consumption expenditures. But economists expect the headline consumer inflation to tick up to 2.9% year over year. You can see that right there. I just highlighted on the screen in case I'm just in your pocket while you're working out or running or something, which is up from 2.7% in the month of July. Now, core CPI, we're expecting that to hold steady at 3.1% month over month, year over year, or just 0.3% month over month. So we're not expecting those to change, but the key detail will be core services, mainly shelter, transportation, medical care, where the monthly pace has quietly firmed back up to around 0.3%. Now, if that holds again in August, it pushes the annualized run rate for core services to 3.6%. Now, that would be a headache for the Fed because it would show that wage-driven inflation in the service sector hasn't necessarily cooled the way that markets have hoped. But that's where we're at, everybody. So today, Oracle has lifted the scoreboard. Gold hit another record. PPI gave us some short-term relief on inflation, but make no mistake, all eyes are on tomorrow's CPI figures that we're going to be getting. Be sure, like I said, to tune in. That's the report that will either lock in a modest rate cut or really complicate the message from the Fed about how aggressive they can be in the months ahead. So investors are betting on cuts. The question is now whether tomorrow's inflation data lets the Fed deliver them with confidence regarding these rate cuts. So y'all, I will be back to talk about what CPI does. Tomorrow is tomorrow's Friday Junior for me, or today's Friday Junior, because tomorrow's my Friday and then I'm off on Friday, on actual Friday, and I'm off on Monday because Sunday is my birthday, everybody. So what you could do for my birthday is you could you could subscribe, you could add some comments and some engagement to my videos, because I was getting some pretty good views, and then my views and everything started falling off. So happy birthday to me, everybody. That's the way you could show me. That's the only gift I want. So everybody, I hope your night's awesome. I'll see y'all tomorrow, and enjoy the night.